Alright, hello and welcome to Team 8, the Rough Riders presentation of the Dell working capital case. So in this case we'll look at various options of how companies finance growth, whether it be internal, external. But first, before we do that, we want to go over some terms to help us better understand how to conduct an analysis of the case. So the first is internal financing, which is essentially when a company uses its own profits to finance further growth. The company can also improve its cash conversion cycle by improving its working capital ratios to help finance growth internally. Next, we'll talk about external financing. This is when a company seeks financing from outside the company. The most common type is borrowing through a bank. However, a company can also seek investments from outside stakeholders by issuing stock, as we'll see in this case. And finally, we'll look at additional funding needed, which is the amount of money a company must raise from external sources to finance the increase in assets required to support an increased level of sales. And the formula for additional funds needed equals increase in assets minus increase in liabilities minus increase in retained earnings. But it's important to note that the calculation for both liabilities and retained earnings take into account only the increase or decrease related directly to sales. Okay, so when we look at the projections based on total sales of $5,296 million and a profit margin of 4.29%, we get a financing surplus of $38 million, indicating that Dell can finance all of their growth internally. And we just applied the formula that we saw on the last page to get to that additional funds needed number. But as we'll see on the next slide, projections are not always 100% accurate. So here we have the 1996 actual change in assets, liabilities, and retained earnings. And if we look at our formula again, we'll see that Dell has a financing deficit of $62 million. Now this $62 million was actually realized by their stockholders' equity transaction, specifically an increase in $188 million of common stock, a decrease in $114 million of preferred stock, and a decrease in other stockholders' equity, which is likely related to the repurchase of their own stock or treasury stock. Another thing to note is that they did convert a lot of preferred stock to common stock, which contributes to the large increase and decrease there. And then if we dig a little bit deeper into the actual financial statements, we see that Dell's other liabilities account increased by $46 million from 1995 to 1996. So that may indicate that Dell took on some additional debt in order to finance their increase in assets, which leaves us with a number of $259 million increase in retained earnings. So the total number, based on how you look at it, of the amount that was financed internally is either $259 million or $259 million plus the $46 million in other liabilities. Okay, so how exactly did various factors contribute to their ability to internally finance growth? First, the profit margin increased from 4.29% in 1995 to 5.14% in 1996 helped their ability to finance growth internally. However, their cash conversion cycle actually became longer over the course of the year. If you take the average cash conversion cycle from 1995 to the average cash conversion cycle in 1996, you'll see an actual increase which hindered their ability to grow internally. Alright, so next, this relates to question 2 on the case. We're going to look at the 1997 pro forma financial statements to determine if Dell can finance further growth internally or if they will have to go outside the company to raise additional capital. And this figure here represents the forecasted income statement based on a 50% sales growth and a profit margin of 5.14%, consistent with the previous year. And the most important number to take away from this is the net profit number, which will carry over to the pro forma balance sheet in the retained earnings account. So here we have the forecasted balance sheet based on the 50% sales growth, and we can see that Dell has a financing surplus of $98 million, which means that they can fund the growth internally. Now this assumes that there are no changes in operating efficiency, debt, or shareholders' equity other than retained earnings, which we carried over from the previous slide. So what if Dell wanted to repurchase $500 million of common stock and pay off all its long-term debt? How would that affect our decision? Well, the resulting pro forma balance sheet is shown here, and you can see that decreasing long-term debt to zero and purchasing $500 million of common stock, which will translate into the other shareholders' equity category, results in a financing deficit of $516 million, meaning they would not be able to fund their growth internally. Alright, so now we'll look at some options Dell could potentially use to be able to fund their growth internally. If they wanted to reduce working capital, it would need to be reduced by the additional funding needed, or $516 million. In order to do this, the cash conversion cycle would have to significantly decrease, and we calculated that it would need to decrease by at least 24 days depending on which working capital ratio is improved. Meaning they could decrease the time it took to collect receivables, reduce the days items remain in inventory, or delay payments to suppliers. While it may be feasible to reduce the cash conversion cycle moderately, 24 days is a lofty goal and somewhat unrealistic. Dell is already performing better than its competitors when it comes to maintaining a low supply of inventory. It could potentially be more aggressive collecting receivables or ask for more time to pay suppliers, but more information is needed to really determine if these are viable options. So let's say there's no change to the working capital ratios. By how much would the net profit margin need to increase in order to fund growth internally? Well, they would need an additional $516 million in profits in 1997, meaning its profit margin would have to increase by 6.49% to an ambitious 11.63%.